In this video, we will look at FHA loans. What is it, how to qualify, why it's good and why it's bad, and the changes for 2022. Most likely, if you're watching this video, you could be a renter right now and are considering buying a home using FHA loans. FHA loans are very popular with first-time home buyers. There are a lot of types of loans out there, but for this video, we will look at FHA loans and compare it with conventional loans. This is usually what I get asked by first-time home buyers. What is the difference between a conventional loan and an FHA loan? FHA loans are backed by the Federal Housing Administration. The FHA is an agency within the Department of Housing and Urban Development. One of its mandate or roles is to provide affordable mortgages and also insures the loans and reimburses lenders if the borrowers fall into default. It's popular with first-time home buyers because it allows buyers to buy a home with as little as 3.5% down versus the typical 20% requirement for conventional loans. Another thing is that credit score requirements are lower. For conventional loans, it's usually around 620 or higher, which actually is a lot higher if you go out there. For FHA loans, they go as low as 580, which I gotta be honest with you, if your score is that low, you may need to address a couple of things before you go out and buy a house. But that's just my opinion. Interest rates are about the same for both FHA and conventional loans. Just keep in mind that the lower your credit scores, your interest rates will be higher. Also, in regards to FHA credit score requirements, if you score lower than 580, you may still be able to get a mortgage, but you will most likely need 10% down. Again, I go back to my previous statement or opinion. If you have that low of a credit score, you may need to be taking care of some other financial issues before buying a house. Okay, so in terms of the down payment, both type of loans allow gift as source for down payment. For conventional loans, your lender may require you to put down a portion of your own funds before being able to include gift money. Not so with FHA loans. Your whole down payment can be as a gift. Now, what about costs? Well, nothing is free in this world, right? All these things have some sort of cost, right? That is true. Let's start with the biggest thing people ask. Private mortgage insurance. So what is PMI or private mortgage insurance? Anytime you put less than 20%, you most likely will need PMI. There are conventional loans that will tell you there's no PMI, but in most cases, it's actually built into the rate, meaning you get a higher rate than you would otherwise qualify for. I'm not going to get into how much PMI will cost you because it varies. Just keep in mind these two things. The lower your down payment, the higher a PMI. With FHA loans, whether you have 20% or more, you will have PMI. Also, with FHA loans, there is upfront mortgage premium insurance on top of the annual mortgage insurance premiums that you pay for. For FHA loans, you can finance this upfront mortgage insurance premium. That in a nutshell are FHA loans. This next part of the video, I'll talk about FHA loan requirements for 2022. You can also go directly to FHAhandbook.com or the HUD website for more info. If you like reading, just Google HUD Handbook 4000.1. Okay, let's go over some of the new or revised loan requirements for 2022. These were announced back in October of 2021. These changes will apply to FHA loans with case numbers assigned on or after January 24, 2022. Quick side note, if you apply for an FHA loan with, say, Wells Fargo, and they gave you a case number, and then you change your mind and did not want to go with Wells Fargo anymore, if you go apply with another bank, you will be using that same case number that you already have. Now, to be fair, there's really nothing here that borrowers should be rejoicing or jumping for joy with these new guidelines. Most of the changes are geared towards the lenders on how they report loans and documentations. All of these, borrowers probably don't even have any idea or clue. Let's start with the application process. Anyone who applies for an FHA insured home loan must complete a standard application form. FYI, this is not only an FHA requirement. You have to fill out what we call a 1003 form if you are applying for a mortgage. This is what it states in the handbook. Quote, the mortgage lender must obtain a completed Fannie Mae Form 1003, Freddie Mac Form 65, Uniform Residential Loan Application from the borrower and provide all required federal and state disclosures in order to begin the origination, unquote. Again, this is not unique to FHA loans. All mortgage loans that I know of use Form 1003. Another important requirement, and one that is kind of a drawback when you have an FHA loan, is appraisal. An FHA appraisal is not only done to ascertain the value of the home, but also to make sure that it meets the minimum property standards for the FHA program. What's the minimum standard? It usually deals with health and safety, meaning is the house livable and safe. I was told once that part of the reason that they do this health and safety and livability check is because most FHA borrowers have limited funds. At least that's the assumption. And FHA wants to make sure that borrowers are not buying a house that is in need of repairs. The assumption is that because of the borrower's limited funds, it's important that they get into a house that they do not need to fix anymore. There is an FHA 203 loan which I won't cover here. Maybe on another video if you comment below. This part of the FHA appraisal is sometimes what sellers don't like, especially if the house looks run down or there's a lot of neglected maintenance. FYI, it doesn't have anything to do with the property being old or outdated. As long as everything is working and there's no hazards, it should be good. It also needs to have a stove. Not sure if that is still the case, but I remember years ago, I was told that's one of the musts. And heating. FHA appraisals are valid for 120 days when an FHA loan is being used. This is important because there have been times where a buyer gets a property appraised, and then if it doesn't appraise, they think that they can get another appraisal in the hopes that a different appraiser might come up with a different value. No, unfortunately, you will be stuck with that appraisal value for the next 6 months. Now, cash to close. This is again one of those things that is not special to FHA loans. Basically, your bank needs to know how much money you have or how much money is needed to close a loan. This has to be documented. It cannot just magically appear in your bank statement. For example, if the cash to close that is needed is say $50,000, you need to have at least $50,000 in the bank, or say you only have $25,000 and then you have a gift from your parents or a rich uncle for another $25,000. Now this gift also has to be documented. Don't just transfer it into your account and say, Uncle Jeff Bezos gave it to me. I highly suggest you talk to your lender before moving any funds around. Another thing, you don't have to show all your funds to the lender. Say you have a bank account that can cover the cash to close and you have another account with additional cash. You don't have to show this bank account. Now, in the event, say that the cash to close that you were told that was needed, for some reason, jumped by an additional $10,000. You again have to be able to show where this additional $10,000 is coming from. This is where that additional funds that you didn't show might come in handy. So long as the funds that are in there are seasoned, season just means it's been there at least for 2 months in your account. This is what it says in the handbook, 4000.1. The mortgagee must verify and document that the borrowers has sufficient funds from an acceptable source to facilitate the closing. Unquote. I touched upon credit scores earlier. Like I said earlier, you can have a credit score as low as 500, but you will need 10% down. With at least a 580 credit score, you can qualify for 3.5% down payment. Now, just because you can put 3.5% doesn't mean you automatically qualify. You still need to hit the debt to income ratio or DTI. In terms of documentation, we will only talk about W-2 or salaried borrower. Again, this is similar to regular or conventional loans. 2 consecutive pay stubs, W-2 forms, 2 months bank statements, 2-year tax returns are typically what's being asked for. They can ask for other information as needed, but this is the most basic that a borrower would need to provide. Down payment. This is one of the best things about FHA loans, the 3.5% down payment. So on a $600,000 purchase, instead of a 20% down payment of $120,000, you can put as little as $21,000. Again, the caveat here is as long as you qualify, your DTI and your credit scores meet the requirements. Income requirements. This is where a lot of people get hung up with, which really annoys me. You see, there are a lot of requirements when you are applying for a loan. Whether it's an FHA loan, a conventional loan, the lender needs to make sure that you can pay the loan. They don't know who you are, or nor do they care if you're a good person. In other words, They need proof, and usually proof comes in the form of the following. They need to document the borrower's income and employment history, at least 2 years of continuous employment in the same line. If say you just moved to a new job, as long as it's a move up in the same function, it should be okay. In other words, if you are, say, an auto mechanic and you move from a local shop to a dealer in the same job function, that should be okay. But say, if you're an auto mechanic and then you move to become an accountant, that most likely won't count. It has to be 2 years of continuous employment in the same line of work. Lenders also need to verify the accuracy of the amounts of income being reported and determine if the income can be considered as effective income. I think a good example for this would be overtime. Say you're making big bucks in overtime. The question will be, one, will the overtime continue into the future? And two, if there was no overtime, meaning you won't include that in your income calculations, would you still qualify? Tax filings are important because this is what lenders typically rely on. Sometimes people don't file their taxes on time, and in those cases, usually the lenders might use your 2 latest ones, which if you are banking on your current income or new earnings to qualify for the mortgage, it could be an issue. Loan amounts. Here's the bottom line on this. There are different loan amounts or loan limits. But before going to loan limits, let me share with you a quick example. Let's say you wanted to buy a single family house for $1,500,000 and you wanted to put down 3.5% and your debt to income ratio still qualifies you. Well, you cannot get a loan for that because there are loan limits for FHA. Here are the 2022 new loan limits. It varies by county. There are low cost areas, medium cost areas, and high cost areas. In my example, even if you were in a high cost area, your maximum loan amount can only be $970,800. Now, can you still get a loan for that $1,500,000 per purchase? Answer is yes. You can have a loan for $970,800, meaning your down payment would be $529,200. Now, you might ask why you would still get an FHA loan if you had that big amount of down payment and your income is great. You know what? It could be that the credit score is low and the borrower might not qualify for a conventional loan. We talked about mortgage insurance earlier. Basically, all FHA loans have PMI. There are 2 types of PMIs that the borrower pays. Upfront, when you first get the loan, and the monthly or annual insurance premium. I won't get into calculations because I almost always screw it up. I highly suggest to get this from your lender because it could get expensive. Just an FYI, I googled FHA premiums for 2022 and I couldn't find it. I went on the HUD website and it was amazed. But for 2021, the upfront insurance was 1.75%, which has been the same for several years now. And the annual mortgage insurance premium is equal to 0.85% of the loan amount most FHA loans charge. Again, I highly suggest you talk to your lender to get the actual calculations. To get an FHA loan is easy. Most banks are FHA approved because it's a very popular loan. So you can apply with your local bank. Most big banks like B of A, Wells Fargo, Chase are FHA approved lenders, so you can also go directly to them. Now, one last thing that I just remembered that is very important. It has to be owner occupied. You can't use it to buy an investment property. The other thing too is also keep in mind that if you're getting or considering buying a condo, the condo complex has to be FHA approved. Otherwise, you can't get an FHA loan on it. Years ago, it was hard or it takes a while to get a condo complex FHA approved. I believe now you can expedite the process. It takes less than 30 days, I believe. So the 2 biggest pros of FHA loans are low down payment requirement and low credit score requirement. Also, another plus is that you can get your whole down payment as a gift. The biggest con is the upfront cost. This is where a lot of buyers get confused when I tell them that you need more than 3.5% to buy a house with an FHA loan. The biggest fee is upfront mortgage insurance premium. Now, this next part of the video might not apply to where you live. Here in the Bay Area, if you have an FHA loan, you're in a bit of a disadvantage, primarily because competition is so tough around here. If you have an FHA loan, you are competing with buyers with at least 20% down, in a lot of cases cash buyers as well, which ultimately leads to the next question that I get. Does it matter to the sellers in the end if it's a conventional loan, an FHA loan, or cash? Short answer is no. Once the transaction closes successfully, it really doesn't matter to the seller even if it was cash, because they get the same amount. The misconception about FHA borrowers are that they not only have lower down payment or not a lot of funds, but also that they have poor credit. In a very competitive market where people overbid for properties, an FHA borrower with only 3.5% down most likely can't make up any of the difference between the agreed upon purchase price and any appraisal shortfall. Say again, let's go back to my example of a $600,000 property. It gets a bid of $650,000 and the appraisal only comes in at $625,000. If an FHA buyer only had 3.5% down payment, how are they going to make up the $25,000 difference? Okay, that's it for FHA. Hopefully I wasn't rambling and you got a lot of useful information out of this video. As they say in the YouTube world, give us a like if that is the case, and consider sharing this with other people that might find it useful. And while you're at it, subscribe to our channel. Hey, thanks for watching, and I hope your 2022 is the start of something amazing.